between now and December, we're going to get a really nasty negative surprise on one of the employment reports, and that'll tip the odds towards a 50 basis point cut at some point. Will this really be the first time ever that the Fed engaged in such a gargantuan tightening cycle in such a credit-driven economy and inverted the yield curve and nothing bad happened?
It's Friday, August 23rd. Stock markets and gold are rallying on the back of Jerome Powell's speech at Jackson Hole. We'll be going over what was discussed, why markets are going up, the outlook for markets and the economy, and updates to the labor market and strength of the jobs market with our next guest, David Rosenberg, president and founder of Rosenberg Research. Always great to have you back on, David. Welcome back.
Thanks. It's great to be back on, David. Thanks for having me.
Appreciate it. So today, looking at the charts, the S&P 500 as of around noon Eastern time, up about 60 basis points. The Nasdaq is up 1.1%. So Fed Chair Powell says that
as we highlighted in our last FOMC statement, we are attentive to the risks to both sides of our dual mandate. The time has come for policy to adjust. The direction of travel is clear, and the timing and pace of rate cuts will depend on incoming data, the evolving outlook, and the balance of risks. We will do everything we can to support a strong labor market as we make further progress toward price stability. With an appropriate dialing back of policy restraint, there is good reason to think that the economy will get back to 2% inflation while maintaining a strong labor market.
I wonder why the market's rallying on what he said, because the Fed minutes came out this week and basically said the same thing. Correct me if I'm wrong, but the FOMC minutes released this week said that, well, it's likely that we're going to get a cut by September. So I don't know if there's any new information given at the Jackson Hole speech today. What's your interpretation?
Well, it's interesting, David, because I was getting calls from clients asking me actually if Powell was going to sound either less dovish or a tad hawkish today, premised on, what the stock market's been doing and the overall general accommodation of financial conditions. So there was, I think, a little bit of residual concern that maybe he wouldn't be quite as dovish as he turned out to be. So, and I think that he stepped it up from where he was, back at the last meeting at the press conference on July 31st. He was setting the table, and I think that today he actually served an appetizer because, the tone and the nuances in these speeches and these press conferences are so important. And I think he just stepped it up a lot. The emphasis on the confidence he now has that inflation is returning to target, the tone, and saying the word confident, without any pause or without any caveats. But more to the point, I think that he made reference to the labor market 12 times, okay? And not in the sense that we have an overheated labor market. His concern is that the labor market is loosening at a more rapid rate than the Fed had thought. And he doesn't want to see, as he said, any more erosion in the labor market, even though there's been no net layoffs, at least coming out of the payroll survey. So I just think it was the really emphatic tone that the Fed is now not just concentrating on the dual mandate, but he seems to just suggest that we have moved away from the inflation cycle and now we're moving towards putting a floor under the labor market cycle. So I think that we just basically flipped a few more pages in that book of moving towards a new cycle in interest rates. And I think that's what the markets have interpreted.
He said that
inflation has declined significantly. The labor market is no longer overheated, and conditions are now less tight than those that prevailed before the pandemic. Supply constraints have normalized, and the balance of risks to our two mandates has changed. Our objective has been to restore price stability while maintaining a strong labor market, avoiding the sharp increases in unemployment that characterized earlier disinflationary episodes when inflation expectations were less well anchored.
What is he referring to? Is he perhaps alluding to the downward revisions in job growth when the BLS 818,000 revealed this week, which is the most significant downward revision, by the way, since 2009?
I think that he was referring actually to more the labor market ratios than he was actually to the level of employment. I think that he didn't touch on the downward revision, and of course, the pace of job creation, even in that 12-month period, was still pretty good. It just wasn't as hot. The most important comment from a specific data point that he mentioned was combining the household survey and the JOLT survey, and something that we know has been near and dear to Powell's heart for the past few years, which is the ratio of job vacancies to unemployment. And that now has moved to 1.20. And when the Fed started cutting rates in 2019 in the fall, it was 1.24. And I think you're 100% right. That's actually the most important thing that he said was that that particular ratio is showing that the labor market is looser, not worse, just looser in terms of the slack in the labor market than it was at that point in time. And then I connect the dots and say, well, by the end of 2019, before COVID, they cut the funds rate to 1.75. And we're still sitting here today at 5.4 in the funds rate. So I just say, nice to know what the destination point is going to be for the front end of the yield curve. And that was a lot of information that he gave in just that one sentence.
Before we continue with the video, let me tell you about how to protect your online privacy. Do you know how much of your personal information is on the internet? Well, data brokers collect and sell your personal data, exposing you to risks like identity theft and potentially harassment. But there is a solution. Delete Me, the sponsor of this video. Delete Me removes your personal information from hundreds of data broker websites. I use Delete Me myself, and it's simple. Just submit your information, and their privacy experts handle the rest. In 7 days, you'll receive a privacy report showing where your data was found and removed. Delete Me continuously monitors and removes your information all year long. Now, get 20% off on consumer plans with Delete Me. Go to joindeleteme.com/David Lin and use the promo code David Lin at checkout. You can also scan the QR code on the screen here directly from your phone. Join the thousands who trust Delete Me to keep your data private. Get Delete Me today and start taking control of your online privacy. Yeah, let's talk about the yield curve. The dollar was down significantly today. What is the dollar anticipating in terms of the yield curve changing?
Well, I think what the dollar is telling you is that the Fed is going to start to play catch down on interest rates with what other central banks have done, whether it's in Canada, whether it's the Bank of England, the ECB. I mean, the Reserve Bank of Australia is dragging its heels. The BOJ may be raising rates in a different part of the cycle. But I think that the dollar is telling you what the front end of the curve is telling you, which is that the Fed has allowed itself to get behind the curve. And I think Powell's remarks today was basically saying we may be behind the curve, but we're not going to stay behind the curve that much longer.
So can you evaluate this statement for us? He said,
overall, the economy continues to grow at a solid pace, but the inflation and labor market data show an evolving situation. The upside risks to inflation have diminished, and the downside risks to employment have increased.
So 3 points we can evaluate, please, David. Economy growing at a solid pace, upside risks for inflation having gone down, downside risks for employment having gone up. Let's start with the economy.
Well, that actually, all those 3 points really boil down to two words. This economic nerdsy term called output gap, which is about slack in the economy, which creates disinflation pressure. So that's really what he's alluding to. And that's actually what's in the data. And it is actually remarkable. This is actually remarkable post-COVID environment that we're in right now. When you consider that over the past 4 quarters, real GDP growth in the United States has been 3%. Think about that. That's pretty good. That's aggregate demand. GDP is all about spending. We had 3% GDP growth, yet the unemployment rate has gone up 80 basis points. The industry-wide capacity utilization rate, which is the unemployment rate for the business sector, that's come down by 120 basis points. And core inflation has come down 150 basis points, all in the context of 3% growth in aggregate demand. And the only way that that can happen is if aggregate supply is expanding faster than aggregate demand. Basically, what's happening with labor force participation combined with productivity. And when you back out that data as an economist, it's telling us that the supply side of the economy is expanding at 4.7%. And that's why a lot of people think that we're in a recession or what they call a vibe session, because you've got growth on the supply side running so far above the demand side. And now, by the way, the demand side is no longer a 3% growth economy. It's now closer to 2%. So that disinflationary output gap uh, is actually widening as you and I have this conversation. That puts downward pressure on inflation. It'll put downward pressure on corporate profits, although not priced into the stock market just yet. And it is going to put ongoingly upward pressure on the unemployment rate. And at some point, the dam is going to break. And so people say, well, it's been a benevolent rise in the unemployment rate, 3.4% at the low to 4.3. There's been no job carnage. However, the unemployment rate is still an important barometer because it tells you how the supply and demand curves are moving in the most important market in the economy, which is the labor market. And as the unemployment rate goes up, what happens is that with a lag, nominal wage growth goes down. And ultimately, the dam breaks, and wage growth goes down enough that people curtail spending. Now, right now, all you're seeing, and you're seeing it in the data, and you're seeing it amongst the retailers, that consumers haven't really pulled back in entirety, but a lot of frugality is going on, right? A lot of shift towards no-name products, a lot of trading down. You're hearing about Lamborghinis and Jaguars and BMW convertibles being parked outside the Walmart. Walmart's saying how it's grabbing market share among high-income individuals. Well, you see, people are becoming more discerning in their spending patterns, value conscious, bargain hunting. And that happens traditionally before the actual retrenchment in consumer spending. So we're in that fog right now, that transition. But that's why he's focused on the labor market, because even though you've had this run up on the labor market in the unemployment rate, with a 3% growth rate, think about that 3% growth, unemployment rate up 80 basis points in the past year. So, David, what happens when we start to see growth slow down to 2% or 1%? And the next thing you're talking about is a five handle on the unemployment rate, in which case, by the way, at that point, um, the consensus will move from soft landing to recession, and the Fed's probably going to be cutting rates a lot more aggressively. And admittedly, that might be more next year's story, but that is still going to be something that will be making the headlines at some point over the next 6 to 12 months.
I'd like you to comment on this, please. I've had more than one guest on my show say that the unemployment rate going up is not necessarily indicative of a weakening labor market. Really, all that means is that the labor force has expanded somewhat due to immigration, and so naturally the unemployment rate is going to be higher. Is that true?
Well, it's true, but there's no significance in that comment. So, would the person saying that come to a conclusion that we're getting immigrants into the labor force, but they're not finding a job? And what does it matter if it's an immigrant coming into the labor force not finding a job, or a native-born American coming into
I
the
think
labor
I
force
think the
not finding
point
a job?
I think the point here is that it's not people losing jobs; it's just more people coming in, right? So anyway,
I
I'll
am
let you.
trying to explain that that was my point. Like we
Yeah,
had 3% GDP growth in the past year, and the unemployment rate's gone up significantly. So, yes, you've not had job carnage, but more people are coming into the labor force. What does the unemployment rate tell you when it's going up? Is that people are coming into the labor force, but they're not finding a job. Okay, that's the problem, is that more than 90% of the people coming into the labor force, and frankly, I don't really care if they're immigrants or whether they're native born. 90% of the people who come into the labor force looking for a job, David, have not found one in the past year. 90. This time last year, 90% of the people coming into the labor force were finding a job. Now 90% of the people coming into the labor force are not finding a job. Well, what does that mean? When more people are competing for your job, David. More people, and you see, you're looking over your shoulder. I haven't lost my job, but there's four people in line for my job. Are you going to go to your boss and say, "Oh, give me a pay hike, please"? I don't think so. So, what the rising unemployment rate does for the existing people who are working is it creates a certain level of insecurity. Maybe that's not the worst thing in the world. It's called competition. But the rising unemployment rate is telling you that there's more competition for jobs, which means that wage growth is going to slow. You're going to be a little more circumspect to go ask for a pay increase over the course of the next, say, 1 to 2 years, by virtue of the fact that there are more people looking for a job and they're lining up for your job. Okay. So that's the significance. So when people say, well, oh, well, you try and paint the lipstick on a pig, fine. Yeah, there's been no net job loss. Absolutely. And you still had this run up in the unemployment rate. The run up in the unemployment rate by itself is significant because of the implications for a very important price in the economy, which is wages. That's the importance.
I believe Bloomberg Economics has a 5% unemployment rate target at the bare minimum for it to rise. Is that in line with what you're expecting?
I think we'll go through it. So, yeah, but I have no problem with that. And once you get a five handle, I don't think that we're going to be sitting here in maybe 3 or 6 months' time having that argument about, oh, well, the unemployment rate is only going up because of labor force entry. And we're going to start talking about job loss. Now, it's always difficult to do this with the non-farm payrolls because half the growth of non-farm payrolls in the past year has come from the birth-death model, which is an algorithm and a net addition, a net skew to the existing survey. Half the growth has not come from the actual head count, okay? It's come from the birth-death model, and that's why non-farm payrolls are a lagging indicator. But the one thing that I'm focusing on that's telling me that we're going to start to see net job loss, I can't predict the exact month, is because I'm watching the hiring rate. The hiring rate is going down like a hot knife through butter. The hiring rate is going down. It's lower than it was before the pandemic. The hiring rate is going down. And the only reason we have not seen net employment loss is because the firing rate has remained so low. So companies to this day are still hoarding labor because of the horrible memory of what happened in 2020, 2021, into 2022, when because of COVID and the lockdowns, and then of course the government paying people not to work much longer, and people were making more money being unemployed than they were actually working. Well, that lasted for a while, but the labor demand supply mismatch and the difficulty companies had finding labor is a bitter and lasting memory for a lot of companies. So they're like the little boy with the finger in the dike, right? And so they've been loath to lay people off for fear that when it comes to the next cycle of hiring, I won't find them again. What they've been doing, of course, is furloughing workers to part-time. All the employment that you're talking about has been part-time work in the past year. Okay, there's been no full-time jobs being created. And we know looking at the work week that, and it's consistent, that companies have been cutting the hours. They haven't been cutting the bodies. So the firing rate has remained low, but the question is, at what point will the firing rate start to rise? And at what point does the hiring rate and the firing rate cross over? And that's critical because that's the month that will print a negative headline on employment. And either people will say, well, it's just a one-off. It's just one data point. Or it's going to cause a lot of people to start figuring out that this recession, which had been delayed, never was derailed. But that's really the key. The only reason why employment's not gone down outright is because the firing rate has remained incredibly low. Question people have to answer is, will it remain low over the next 3, 6, and 12 months? Because the only thing we know with certainty is that the hiring rate, the proxy for labor demand, is falling precipitously. And I don't think that's going to be changing anytime soon.
Let's talk about your outlook for Fed funds rate and what happens after a pivot to markets. Jerome Powell said
We do not seek or welcome further cooling in labor market conditions.
David, can we interpret this statement to mean that they are ready to cut by 50 basis points if needed at some meeting if we're seeing deterioration to the extent that we're talking about here?
Absolutely. He came right out, was very forceful that the pace in this process, and it is a process, and that's the word he used on July 31st. So this is no one-off. This is going to be a steady diet of rate hikes. And
Rate cuts, you
pace
mean?
and magnitude is going to be determined primarily on what's happened in the labor market. So if it deteriorates more than the Fed expects, then they're going to go 50 at one meeting. Will they do that September 18th? That all really comes down to what non-farm payrolls look like before that meeting. Otherwise, if there's not really a significant weakening out of the uh, August employment report, they'll go 25. Now, the futures market, as you quite rightly said, priced for 100 basis points of Fed rate cuts by the end of the year. There's only 3 meetings left, so ipso facto, they would have to go 50 basis points at one of those meetings. I'm sensitive to that view, but I work in a business where your assumptions drive your conclusions. And my assumption is that between now and December, we're going to get a really nasty negative surprise on one of the employment reports, and that'll tip the odds towards a 50 basis point cut at some point.
The risk here that some people have said is a return of inflation if the Fed is aggressive or dovish in their cuts, right? How significant is this risk?
As close to zero as you can get to, okay? Because the counter argument is that monetary policy hits the economy with lags that are long and variable. And boy, were the lags long and variable this time around. So they're going to cut rates. I think cut rates quite a bit. It's not going to show up in the economy till probably 2006. Look how long it took for the rate hikes and the significance of going from zero bound to 5.4 in the funds rate. And really, we're only starting to see the effects in the last several months. Um, we only started to see the effects in the last several months uh, of Powell himself saying finally that he's confident that inflation is going to go down. Look how far the Fed had to go. Look how far the Fed had to go. 0 to 5.4 on the funds rate to get to that confidence. And so people are saying that, oh, we're going to cut 25 or 50 or 75 and inflation's going to come back. Like, you're kidding me, right? They're going to have to cut rates a lot. And I'm not going to say inflation won't come back, but it's beyond my forecasting horizon right now. Okay. Inflation is dormant. It's never dead. It's dormant. And for the next year, the economic energy term output gap is going to be forcefully putting downward pressure on inflation. Now, keeping in mind that inflation is also a lagging indicator, but I ascribe almost zero odds, barring some unforeseen massive supply shock. What I see, and again, what else do you want to talk to the economists for outside of the fact we're a bunch of fun loving people? We're trained to draw supply and demand curves. We have to get the shape of those curves right, the direction, and there's not a snowball's chance in hell that there's anything the Fed is going to do right now or even in the next year that's going to cause the supply demand curves in the US economy to shift in an inflationary manner. Because we're still going to be working off the lags from the last tightening cycle. That is not going away in the next 12 months. So when I talk about inflation, let's talk about 2026, 2027. It is not a clear and present danger if we're talking about over the next 12 months.
Okay, so a Fed cut, one or two cuts, or perhaps even more, not enough to reignite inflation. I understand that. What about fiscal policies? Do you see any fiscal policies from either a Democrat or a Republican win that could reignite inflation?
Yes, well, I think that what will happen if Donald Trump becomes president and he undergoes those really draconian tariff increases, and we run the numbers on these, inflation would come back very temporarily. And in fact, we could see inflation get as high as 6% under his policies. But it'll go there and stay there as long as 9% did, like for a month, and then come back down because tariffs are a one-time price level adjustment. It's not really a sustainable source of inflation. But yeah, will we get an inflation shock under Trump's policies? Most likely. And there'll be some other offsets, right? His deregulation policies will cut costs, uh, and that will actually transcend the tariff increase, which is, like I said, a one-time shift. It's not a sustainable source of inflation, but it will cause a temporary inflation shock, 100%. Uh, these corporate tax cuts that he wants to do down from 21 to 15%. Well, you see, what tax cuts do to companies is it fattens their margins and allows companies to either cut prices or hold prices steady. So you have to take a look at the whole gamut. For a temporary period of time, the tariffs will win out. And so I would say that we go from, say, 2 to 3% inflation under Trump to, say, 6. And so people will say, well, didn't you just say inflation's going to not go up? Well, I said barring a shock. So if he does the tariffs, that's a shock. And so we go up to 6. And by the end of his term, we're probably right back down below 2. And under Kamala Harris, all I can say is that, I mean, her policy plank is going to raise taxes by $5 trillion over the next decade. So I look at hers as being far, despite what she's going to do with, a baby bonus and tax credits, so on and so forth for lower middle income households. Um, Her overall policy is one of a tightening of fiscal policy. And I mean, you can talk about, well, we're going to cut taxes for 400,000 people making $400,000 a year, but a lot of people make a lot more than that, that contribute a lot to the economy. They're going to be facing a much higher tax bill. Plus, I think the real kicker is her proposal to boost corporate tax rates from 21% to I think their number is 27%,
28.
right?
28, yeah.
28. Okay. Well, that I think is actually going to generate the conditions for a capex-led recession. So,
Are higher corporate tax rates inflationary to some extent?
well, I think that it will not be inflationary in the sense that what companies are going to be cutting back on labor and cutting back on spending. So it's
Mm.
going to be a depressant on aggregate demand. We actually ran the numbers, and it's going to create the conditions for higher unemployment and a weaker economy. If you look at the whole thing, it's a very populist policy. It redistributes income to the areas of the population that are very supportive of the Democratic Party, but when we run the numbers, and I'm just saying this impassionately, I'm Canadian, so I'm not voting for anybody until October 2025 in
Sure, yeah.
Canada. But let's just say that I think that overall her policies will probably be even more deflationary through the demand contraction. People haven't factored that in, what it's going to mean for the wealth effect on spending from capital gains taxes. People aren't talking about that. People aren't talking about the actual increase in the corporate tax rate. And there's other taxes. And then, of course, we're just looking at the fact that there's going to be income uh, orientation to lower income households, and you got to factor that in, and that's going to be good for them. But people at the low end basically spend money on necessities for the most part. They're not out buying iPhones and going on vacations to Disney. So, when you run all these numbers out, Trump is more inflationary near term, but it's a price shock that will subside, and its other policies are disinflationary on the supply side. Uh, Kamala's policies are will be more disinflationary on the demand side. So either way, it's even hard for me to build a sustained inflation view out of fiscal policy for the foreseeable future, except for the fact that I will have to write and keep writing if Trump wins on the tariffs to chill. He put in tariffs, back in his last presidency, and it was a one-time shift. And inflation actually started his presidency at 2%, and everybody went hyper on inflation, and inflation finished at 2% under his presidency. So go figure. Inflation is a very complex variable. But when we run all these fiscal policy measures, and we've done them on both planks, inflation only goes up under Trump for a short period of time and it comes right back down again. But if you're taking a look over the whole term, inflation under both policy planks ends up lower then than it does today. And that's really the fundamental point.
Do you have an outlook on earnings growth in the U.S. For the large cap companies, at least? Well, let me phrase it differently. Which factor would be more significant for earnings growth? Fed policy pivot, which we haven't had for several years, or the elections?
I think the Fed is more important, and I'll tell you why. Because the stock market by nature is a long duration asset. And so as the Fed cuts and cuts and cuts and takes interest rates down, then those future earnings, the future cash flows that get discounted to the present value become more valuable. So the Fed is infinitely more important than fiscal policy when it comes to earnings.
Okay, well, I mean, am I right to interpret that the markets, at least today, are interpreting a Fed pivot as being bullish for the stock markets going forward? In other words, can we expect this momentum to continue going up following September's pivot?
Well, I think that right now the stock market is telling you two stories. They're very excited about the interest rate coming down. Uh, and it's not like the lower interest rate, like an economist would look at it, well, this is going to be stimulative for the credit sensitive sectors of the economy. No, no, no. An equity market investor will look at it in terms of a lower discount rate as what that implies for the present value of future cash flows. So that's what the market sees, and they see, coupled with that, a prolonged period of a soft landing where the economy is just going to be continue to grow 2 to 3%. It's going to be so the market right now is pricing in. I hate to use the word Goldilocks, but it is. What upsets the apple cart is if we get a recession, because a recession will cause a contraction in earnings. And right now, the market's priced for a very strong earnings stream out well into next year. And that's what would upset the apple cart. And the historical record shows this, the wide divide. When the Fed cuts rates and there's no recession, and it has happened, the stock market is up 18% in the next 12 months. But if the Fed is cutting interest rates and we get a recession, the market's down 30% to the fundamental lows. So it is true that the Fed cutting rates is very bullish in the sense of what it means for the discounting mechanism for future cash flows. However, a recession will, as it's done in the past, will decimate those earnings in real time. So you'll be discounting those earnings with a lower interest rate, but those earnings themselves will be lower than they were benchmarked against the baseline. And that's the problem with recessions for equity investors, even as rates come down. But right now, the markets do not think there'll be a recession. Ergo, the market's going to take off with lower rates because it believes that there's no recession, and that's the valuations are still too expensive for my liking, but that is exactly the message from the stock market.
You pointed this out in one of your charts. You've shown the Fed funds rate going back to several decades, and in almost every single case following a Fed pivot, there was subsequently an Ember designated recession. The markets must be seeing something is off or something is different this time to be not discounting that this time would be the same as before, right? What is that thing that they're
Well,
thinking of?
well, no, I mean, my tables show that going back in the post World War II period, that when that when the coming out of a Fed rate hiking cycle, 80% of the time you slip in a recession, and 20% of the time you don't. So it's not it's not ubiquitous. You didn't have a recession in the mid 60s after a Fed rate hiking cycle. You didn't have a recession in the mid 80s after a Fed hiking cycle. You didn't have a recession in the mid 90s after the Fed went from 3 to 6% under Alan Greenspan, and we had a soft landing then, no recession. And And that's what I'm talking about. That is the benevolent world for the stock market. Now, the valuation, the starting point on the valuations is far higher today than they were back then. But that's the message from the market, and the market sometimes can either see it's too late, like for example, go to another cycle, go to 2001 after the Fed hiked rates in 99 into 2000. That was the tech wreck recession. Well, the stock market already peaked in September of 2000, and the Fed started cutting rates in January of '01. They actually went intermeeting on January 3rd of 2001 by 50 basis points. But by that time, the market said, Greenspan, you're too late. And the market had already peaked. Well, then you get a situation like we had, for example, in 2007, where the Fed started to cut rates in the summer, and the markets thought, wow, Bernanke has saved the day. The market didn't peak till October 9th of 2007, believing that he saved the day until we found out ex post he didn't save the day. So the reality, David, is you only know these things ex post. All I'm going to say is that the lags this time have been very long between what the Fed has done and the impact on the economy and indeed the impact on the markets. A lot of that is because fiscal policy clogged up a lot of things. I mean, that created a ton of stimulus and acted as a huge antidote to what the Fed has done. But you see, that stimulus is in the rearview mirror right now. But what lies ahead are still the lags of the damage that the Fed has already done. By the way, that was still front and center in the last set of FOMC minutes. So I would say that unless you're willing to say that it's different this time, and there's people that are saying that, and I guess you just hinted at it, was why we didn't go into recession after the Fed tightening cycles of the mid 60s, mid 80s, mid 90s is because of one thing, David, and it was because they didn't invert the yield curve. They stopped short of inverting the yield curve. We had a rate hiking cycle in 2018. And of course, when Trump was trying to pressure Powell to stop, and they didn't invert the yield curve. And so 2019, the Fed's cutting, no recession. Well, we got the COVID recession, of course, in early 2020. But Powell stopped short of inverting the yield curve. And so that's what makes the fundamental difference. So this will be the first time ever if it does happen. And we have to be patient, which I am. Uh, but look, we might look back in history and say, wow, for the first time ever, the Fed did a Volcker-esque tightening of policy, inverted the yield curve, and nothing happened. And it's been frustrating having this recession call. I remember being frustrated back in 2007 as well, and there were different reasons that caused the lags back then to be long. But will this really be the first time ever that the Fed engaged in such a gargantuan tightening cycle in such a credit-driven economy and inverted the yield curve, and nothing bad happened? And although it hasn't happened yet, I'm not a buyer of the view that it's different this time. I'm just a buyer of the view that it's taking longer to play out this time.
Final question, David. How do you feel about bonds, especially longer maturity bonds? Presumably, if we were to expect a disinflationary
Mm.
environment, wouldn't that be bearish for yields and thus bullish for bonds?
Yeah, I've been bullish on treasuries. I've stuck with the view thick and thin, and at least since last October with the peak in yields, it's paid off very nicely. And I think that the biggest declines in yield will be at the front end of the curve, and I see minimally the 2-year note going down to 2%. I see the 10-year note going down to call it 2.5, 2 3/4, and I see the long bond going down to roughly 3.25%. So I think that the yield curve will uh, adopt its more normal positive slope, but I think the whole yield curve will come down, even with the deficits and debts. That will limit the decline in yields. It will not prevent it from happening. People say to me all the time, what about the deficits and debts? And I say the 10-year note has come down 120 basis points from the highs last October, even though there's been $1 trillion of fresh debt added on to Uncle Sam's balance sheet. So it really comes down to the cycle comes down to inflation, the cycle. Fiscal deficits and debts do matter, but they only have a 20% correlation. So yeah, I think that when the expected total 1 year return, if we get down to call it 3.5% on the long bond, or 3.25% of the long bond, is going to be very significant double-digit returns. I do believe that you will be able to make equity-like returns in the treasury market over the course of the next 12 months. And the difference being is that you will not be taking on equity-like risk. So that's my favorite trade.
So thank you for that conclusion. So ultimately, then you're staying defensive for the next 12 months in terms of allocation.
Yeah, and I think within the stock market, I want to be in what I call bonds and drag. I want to be in the rate proxies. I'm very bullish on interest rates, and so the dividend payers, dividend yield, dividend growth, and stable companies, perfectly fine. Utilities, pipelines, telecom, even selected REITs, I think will at least do relatively well in the sort of environment that I'm depicting over the course of the next year.
I don't know if people parking their Mercedes and Jaguars outside Walmart is bullish for Walmart, but time will
Yeah.
tell.
Well, let me just say that you mentioned Walmart. Well, Walmart is the only stock in the S&P 500 that never crushes you in a recession.
Yeah,
It is
yeah,
the
we've known.
ultimate contra-cyclical retailer.
Excellent. Where can we learn from you, David? Where can we read your work?
Well, you can either just Google Rosenberg Research and come on the website, or send us an email on information@rosenbergresearch.com. Uh, all the viewers on this call, be happy to give them a 1 month free trial of everything that we do. But the best way to reach us is either just Google Rosenberg Research, come on the website. It's pretty easy to navigate, and or just email information@rosenbergresearch.com, and one of my client service professionals will get back to you immediately.
Perfect. We'll put the email and the website in the description down below. So make sure to follow Rosenberg Research there. Thank you very much, David. Appreciate your thoughts. Enjoy the rest of August and the summer. We'll see you soon.
Take care.
Thanks for watching. Don't forget to like and subscribe and protect your online privacy. Click on the link down below in the description. Join deleteme.com/David Lin or scan the QR code here for 20% off.